And even in the chat yesterday, the Maruti management didn't talk about the 25% market share in UV.
Okay.
They're bullish on Maruti.
All right, so bullish call coming in on Maruti, and looks like it's not too bad for the markets either, right? Look at the first tick on the index. It's in flat terrain, so the Nifty is hanging on to 19,750. I think it's just, sort of adjusting for itself, the bad news on the global front and the good news on the JP Morgan inclusion. So the Nifty absolutely flat. The mid-cap index is not doing too badly, 40% higher, 40 points higher rather. And the bank Nifty is up almost about 100 odd points. The big movers are the banks this morning. So there is some respite that's coming on that front. SBI, HDFC Bank, IndusInd Bank, Kotak are all in the green. The Bajaj twins are not doing too badly either. Bajaj Finserv, Bajaj Finance are trending in the green as well. And you have something like in IndusInd Bank, UPL is up about 0.3%. L&T, Adani Enterprises are also trending in the green. And Reliance is batting for the bulls this morning. On the downside though, Wipro, of course on the back of the resignation, is down about 1%. Autos in the last couple of days have come in for profit taking. So M&M, Bajaj Auto are down in the red. Divi's Lab, Apollo Hospitals also tad bit in the red. Sun Pharma, nothing alarming, just about 0.5% lower there on these stocks. And then you have something like a Hindalco and Tata Steel that are trending a tad bit in the red. So, it's a absolutely flat market. It's like a kind of a tug of war.
Yeah.
And it's just ending right there in the middle, right?
Well, I would have been happy if we actually started off 100 points lower, because we would start off closer to a crucial support zone. And then, in fact, I think, as I said earlier, maybe the odds were that we could bounce off there. But the Nifty Bank, that's the one clearly that's doing very, very well in today's trading session. So that's the one, in fact, that's been a bit of a drawback. That's outperforming. That's good news. A few of those banking names that deserve special mention. You have IOB as well as UCO Bank. Both of them have moved up, gap up actually. But just a caution out there, the float out there is very, very limited. So keep an eye out on that one. You have PNB Gilts, well, because of the bond portfolio, as we highlighted earlier, that stock's up more than 10% as we speak. On the downside, you have stocks like Glenmark Pharma. Yes, they're going to be deleveraging their books, but it seems the street would have rather liked them keep it. So the knee-jerk reaction that we're seeing out there is Glenmark Pharma is lower. Let's pull up Glenmark Life Sciences. Now, they'll have a new owner. They won't be under the Glenmark group. So Nirma will be the new owner out there. So Glenmark Life Sciences as well should come up for you on the screen. Both of them actually have opened up lower. Moving to the other stocks that are in focus, you have GMDC that's opened up with a cut of around 3%. It had a one-way run from around 200 to around 290 rupees, but that's pulled back a little bit. GMR Power, for the second day or third day running, actually that stock is lower. It went all the way to around 45, 46 rupees odd, and now it's at around 39 rupees. I think it's down close to around 5%, and volumes are massive as well. So keep an eye out on that stock. And Electronics Marked, that's the other stock that opened up with a cut of around 4%. Let's see what it's doing. Yesterday, in fact, it was outperforming for most of the day. Rima, what else?
Well, broadly, IT and Pharma are under pressure. So the Nifty IT index is lower by 0.4% and the Pharma index is down 0.3%. The reason here is the rupee has appreciated. And as inflows come into the bond markets, foreign inflows, it could it could result in rupee appreciation, which is negative for exporters. So today, even as the Nifty and the Sensex are held up, there is strength in the banking names. The two sectors which are weaker are IT and Pharma. And in that, you've got Wipro, which has taken the biggest brunt. And of course, that's on the back of the exit of CFO. So Wipro is down 1.2%, but the rest of the pack too is under pressure. So just wanted to highlight the weakness that we're seeing over there. PNB Gilts, we were talking about it, Nigel, but again, look at the, it's at the intersection of volumes and on price. The volumes today on PNB Gilts is more than 50 lakh shares, and just in the first, 2 or 3 minutes. So that's a stock which deserves mention. And RVNL, there is that order win there, so it's pushed up by 3%.
Actually, it's interesting you make this point on IT, right? Because yesterday as well, after the Fed, ever since the Fed policy came through, the expectation of higher rates for longer is something that has put pressure on a lot of these high growth sectors like IT. The Nasdaq was down quite a bit yesterday as well.
Nasdaq is down 5% this week.
Yeah, so there's a lot of pressure actually on the tech space. But overall for the market is picking up pace now, so don't lose sight of that. The mid-cap index is now up 170 points. We have Harsha Upadhyay, the President and Chief Investment Officer Equity at Kotak Mahindra Asset Management, who joins us now to talk about that. Harsha, thanks a lot for joining in and appreciate your time here on CNBC-TV18. This inclusion of India in JP Morgan's global emerging market bond indices has really got the market's, energy going this morning. But you tell us how much of it you think is already in the price, and in terms of flows, what are you expecting and what would the implications be for equities?
Definitely, it's a very positive move for Indian economy and Indian fundraising, I would say. Clearly, the cost of funds will go down, and availability of resources will also go up for our corporates and our government. So to that extent, it's definitely a positive, although it was expected over last few quarters in terms of likely inclusion, etc. But I think the news itself is a big positive, and we are likely to see upwards of $20 billion in the first year itself. So definitely, it's going to reduce the depreciation risk on the currency, will make our economy more resilient. So definitely a long-term positive.
Okay, all right, Harsha, good morning and thanks so much for joining in. By the way, the Nifty Bank actually is the one that's outperforming in today's trading session. It's on the verge of moving to around the 50 DMA as well as the 20 DMA that it broke yesterday. Harsha, but on the Indian markets on the whole, how are you feeling? Are you feeling a little bit more cautious or are you still constructive?
Nigel, our view on Indian markets hasn't changed for the last couple of weeks, I would say. Clearly, when you look at the markets, while Nifty or the large cap index is more or less in line with the fair range of valuations, there is a valuation premium for mid and small caps. We have seen very, very strong rally in that basket. We have also seen a lot of flows going into that segment. So given all this, we continue to remain a little cautious on mid and small caps at this point of time. Overall, on the markets, we continue to remain constructive, but within the market, equity markets, we would rather prefer large caps at this point of time.
You said you're cautious on the mid and the small cap universe largely. Which are the segments where you booked profits?
We have booked profits across many sectors, especially on slightly elevated valuations in the industrials, for example. We also booked some profits in the financials over the last few months. Auto is something that we have taken some money out of the table. So it's not one sector which has led to concerns on valuations. As you would see, the market, more or less, most segments of the markets are either fairly valued or expensive. So to that extent, wherever we feel a little jittery in terms of valuation risk, we have taken partial profits. And at the same time, we are not sitting on large amounts of cash. It's going to some other sectors or stocks where we feel on a relative basis a little more comfortable.
Okay, there's a large rally that you're seeing at the moment in banks and in domestic cyclicals, so don't lose sight of that. Union Bank is now up about 5%, IOB is up 4%, Canara Bank, it's primarily in PSU banks, the rally that's coming through, right? And on huge volumes as well. I mean, IOB I think has over 3 crore shares traded already, so massive move there. You know, the big argument now is on PSU banks, right, Harsha? I know we've discussed this ad nauseum, but how do you approach it from here on in case you missed out on the big rally? Because PSU banks as a theme has not generated wealth for investors if you map a 5 or even 10-year period. Do you think this time is different?
Clearly, I think the asset quality issue, which was the pain for PSU banking segment as a whole, is no more a big concern. So to that extent, probably it will do better than what we have seen in the previous cycle. But that's, at the same time, at some point of time in the near future, many of the PSU banks will also come for equity raising since they have to go further from these levels. So to that extent, I don't think it's going to be a unidirectional move going forward. Yes, we have seen a large re-rating in most of the PSU banks, but from here on, I don't think it's going to be similar kind of outperformance. However, we do believe that not just PSU banks, but the entire banking space will probably continue to outperform given how its earnings are likely to grow and how its asset quality is shaping up over the next few quarters and years.
You know, Harsha, on the PSU banking space, my limited point is to look at the float as well at times of some of these companies. There's only 2 or 3 or 4% in the market, and some of them are trading at 2, 2.5, 3 times odds. So just to alert our viewers, some of them, you know, just be a little bit cautious out there. If you want PSU banks, I guess the larger ones with liquidity should be better. But Harsha, what about the IT space? That surprised everyone, right? The IT stocks itself, the commentary wasn't great. They were sounding a little bit cautious. But those stocks have only moved up. Now comes the challenge because the Fed, they're talking about higher interest. Maybe the rupee strengthens out here as well. And Q2 may not be very, very encouraging. How do you approach them?
Most of these things are known to market participants, I would say. The only reason for IT sector to outperform was probably there was a bit of an under-ownership given underperformance of this segment as compared to some of the domestic cyclicals, etc. And also, we did see some concerns coming on the market valuations as a whole. So to that extent, maybe some of the defensive positions moved into IT segment. And that's what, on a relative basis, in the very near term, created outperformance of IT stocks. But otherwise, as you clearly mentioned, the business momentum continues to remain question mark. We have not seen any great respite in terms of the business momentum. And there are also various company-specific issues, margin issues, etc. So overall, I don't think you're going to see the earnings growth trajectory changing too much for IT sector at this point of time. And there are many other domestic facing sectors which are probably likely to give you better earnings growth than the market average earnings growth or even the IT sector average earnings growth. So to that extent, our preference is still for domestic businesses than IT at this point of time.
Domestic businesses and IT, those are your preferred sectors. Harsha, just getting back.
No, Sonia. I said we prefer domestic businesses over IT.
Over IT, got that. Just getting back to the point about banks, you said banking earnings are likely to be better. Yet in one of the answers, you said that you booked profits in select financials. Do you want to tell us where you've booked profits in financials,
We really do not discuss stock-specific trades or investments that we have done. But yes, in certain pockets of the financials where we felt that we have made a reasonable amount of money, and we did see some relative valuation gap emerging in some of the other segments within financials itself. That's why we moved out.
But this would be private or PSU financials? Or would it be the NBFC category?
Mostly from private banks to NBFCs.
Okay.
For the market now, the mid-caps are really roaring. It looks like another mid-cap party in the markets. I just wanted to point out, Berger Paints is at a fresh high this morning. It's up about 2%. It's had a rollicking ride this year. Berger Paints up almost 40%. I think 35% in 2023 so far. So consumption is coming back perhaps. Harsha, before we let you go, when you sort of zoom out and get a bird's eye view of this market, right? There are a couple of things that are still headwinds, whether it's higher crude prices, whether it's the impending general elections. In the run-up to the elections, we never know if there are any announcements that are made which may or may not be market positive. Not too sure, but what are your thoughts on a couple of these cues? Do you think that they could impact the markets in the near to medium term?
Sonia, I would add one more to your list on the monsoon risk. I think over a period of time, market, because of the kind of liquidity that has come into the markets, has probably ignored this risk. But today, when you look at the cumulative rainfall season, it's almost a 7% efficiency as compared to the normal monsoon season. And generally, when we have seen in excess of 6% efficiency, we have seen some temporary impact on food inflation and also food availability. And we have seen some impact on rural consumption. So already we have seen a kind of a tepid rural consumption for the last several quarters. And if this monsoon is going to be a risk, then probably that's going to delay the recovery that everyone is expecting. Yes, this is a pre-election year. We do understand that there will be social-oriented schemes that will help the rural economy to some extent. But nevertheless, monsoon will remain risk at this point of time. Secondly, as you mentioned, crude has moved almost 30% from the lows that we had seen a couple of months back. And definitely that's going to have a lagged impact on the profitability of many companies in India. And at this point of time, especially the mid and small caps are looking at an earnings growth of anywhere between 25 to 30% for the next 1 year. So to that extent, whether those earnings growth numbers will come in or will there be a change in earnings is something that we need to watch out for. And especially at higher valuations, as I mentioned, the delivery of earnings for this basket will be very, very crucial, I would say. And then there is the election risk, which is also there. So I think these are some of the red flags at this point of time. And especially as valuations move up, we need to keep some of these in mind.
All right, Harsha, have a great weekend. Thanks a lot for joining in and speaking to CNBC TV18. That's Kotak Mahindra AMC with their market view. And by the way, the market is not doing badly at all. Given the kind of global cues, the Nifty is absolutely flat. It's the JP Morgan inclusion, which is sort of overtaking the global cues at the moment. Mid-cap index also not doing too badly. But one space that is really booming is the real estate space. My recent visit to Bangalore actually taught me that there's rapid urbanization happening in Bangalore. And Dolat Capital put out a report where they said that Bengaluru is registering the highest growth amongst all metros in terms of projects coming through. Brigade Enterprises arm Brigade Tetra Arc has acquired a 5-acre land parcel in Bengaluru for 123.5 crore rupees from Bangalore Ceramics. The company plans to develop a residential project with an overall revenue potential of 800 crore rupees. To discuss this and the demand trends, Pavitra Shankar, the MD of Brigade Enterprises, joins us now. Pavitra, thanks a lot for joining in. Before I ask you about your own project, there's so much urbanization that's happening in Bangalore at the moment. One wonders what's going to be the pricing trends, because at some point there's going to be such an oversupply, right? What is your own view of which way prices would head?
Hi. The pricing in Bangalore has been doing well. In fact, the overall market has been doing extremely well. It's about time. I think we've all been waiting for the upcycle in the residential sector. Bangalore has always shown excellent growth. In fact, it's been one of the top housing markets over the last couple of decades, and it's shown stable growth. What's been happening over the last few years is that there has been very low supply. So, and also the demand from customers has been to invest in real estate. So the pricing trends have really supported this despite inventory coming to market as well. So we've seen a dramatic price increase across our portfolio. It is still being supported by customer demand on the ground. And despite whatever supply is being planned by us and others in the space, we're still forecasting very good price growth, because fact of the matter is there hasn't been a lot of supply in the market. And I think the market is still growing in terms of job creation and people moving to Bangalore. That's why you're seeing the rapid urbanization.
All right. Good morning, Pavitra. Well, good times for you guys then, right? Demand is strong. Pricing as well is strong. I don't think you can ask for more. But you've also gone ahead and bought a land parcel by one of your arms, I think 120 crores, or with a revenue potential of close to around 800 crores. Give us further details out there. Will you be looking at doing a luxury project, since you're already talking about it being a residential project? How many flats, ticket size? Give us more details.
Yeah, so we're still in the design and planning phase, but I can say that this is a very good submarket of Bangalore. It's a growing market. North Bangalore is where a lot of the investment and growth of the city is heading towards the airport. A lot of infrastructure is coming into the area. So that is why it supports so much growth as well. Many parts of the city otherwise are saturated. If you look at east, southeast, etc. In terms of growth, North offers a lot of good land parcels, and I think that is why growth is heading in that direction, supported by infrastructure. So for this parcel, it's about 6 acres. We'll be able to build just under 1 million square feet or so. We're planning to build a premium product here. I think that's an underserved market in this location. We're doing apartments. In terms of exact ticket size and pricing, I know we'll just be going as aggressive as possible, since this is the time to sort of do that. But in terms of exact unit sizes, etc., we're still on the design phase, but mostly it'll be larger units, since that's what the demand seems to be on ground.
So Pavitra, how did you arrive at the revenue potential of 800 crore rupees? And what's the timeline of realizing that?
So we would launch the project as soon as we feasibly can. We're in the design and approval stage. Hopefully we can launch it by the end of the financial year. That's our target. Revenue potential, we look at pricing growth, what we assume we can expect and grow over the course. But again, it's a function of how fast we want to move inventory, or whether we want to pursue a realization strategy. I think that we would be able to finalize once we hit the market and understand if the demand and the product that we've planned for is actually meeting what customers want.
So an average price would be around 8,000 rupees, right? I mean, just putting in the mathematically.
Yeah, if you just want to do a very simple math, but yeah, sure. There are a lot of other factors, but approximately so, yeah.
I just had one follow-up on the property prices in Bengaluru and, your view on that. I read an article which said that the prices are expected to increase further from the 1st of October after the government plans to raise the guidance value. So that will come into force from the 1st of October. Just for the benefit of our viewers, can you explain to us what the implications of this would be? And will that have a major impact on property prices in Bengaluru?
See, the guideline value is just an indicative value at which you can register your properties. Generally, people have already, from when they're buying from a good quality developer, the price at which they're buying is typically higher than whatever the guideline value is. However, in some situations, I think the guideline value can be a little more. So the effect is really on registrations. A lot of customers are coming forward to register their properties prior to the guideline value increase, since it could have an impact on their registration and stamp duties and so on. So from that perspective, we're seeing a lot of rush of people heading to registration. However, there are a lot of issues with the new system at the sub-registrar's offices. So there are some challenges on that front as well. But apart from that, we don't see it really impacting otherwise.
So you're saying, sorry, just one follow-up. You're saying that before the October 1st, people are, rushing in to register. So does that mean your own, sort of sales or collections would also go up now? And is that not a great way to sort of map it for the rest of the year? Just trying to understand what the numbers would look like for you over the next couple of quarters.
So our registration revenue is anyway planned based on, which projects are coming up for OC. So we have good clarity in terms of, how busy the registrations, it will be on the registrations front. We anyway have a couple of large projects that are registering that have got OC over the last quarter or so and have been registering, and many customers are coming forward and registering. So we do expect good registration avenues for Brigade in the coming year, since many of our large projects that we launched, say, 3.5 years ago, are complete and are coming forward for registration. And many of these, many of the customers are also end users. So they do want to go ahead, register, take possession, and start living there. That said, the pressure from the change in the guideline value could be pushing some of them to come forward and register. But as I said, in many cases, it doesn't make a major impact in terms of what they have to pay in terms of registration and stamp duty.
I think, Pavitra, you all had indicated that you all plan to launch about 7.5 to 8 million square feet this year.
Yeah.
Considering that this new project could be launched before this financial year ends, do you think you would like to up the new launch, target? And what would the number stand at? And how much have you done up until now, till September?
So the number that we indicated, the 7.5 million, that was at the end of last quarter. It's basically a 4 quarters rolling projection, and it included this project because while we've concluded the transaction, we had already, tied down the property in terms of putting forth some money. So that had already entered our land bank. So in terms of how much developable land we have, in terms of our launch pipeline, our strategy is typically to acquire land and immediately put it into the pipeline for design and launch and sales and so on. So this was already part of that. So I'm not going to up the numbers. That said, we have, I think we released the news about our Hyderabad acquisition.
Yes.
So we'd enter the land bank post June 30th. So that is a new addition to our land bank, plus another maybe 3.5 million square feet that would be entering our launch pipeline. But I'm not sure if we can do it in the next 4 quarters, although that's the goal. But we'll have to see in terms of design and approvals.
Okay, all right, Pavitra, thanks a lot for joining in. Appreciate your thoughts here. That is Brigade Enterprises talking about the big boom that we're seeing in the real estate market, especially in Bengaluru. And they plan to develop a new residential project there. Let's slip into a quick break. On the other side, then Nikhil Chopra, who's the CEO and whole-time director of JB Pharma, will be joining in to discuss an outlook on their business. Stay tuned.
Welcome back. This is Corporate Radar, and you're tuned into CNBC-TV18. Well, the markets, they're zigzagging between the positive and the negative terrain. For the time being, we were down close to around 20 points odd. We've recovered, so it appears there is some kind of buying at lower levels. And the key constituent of the markets that are doing well is the Nifty bank that's been relatively underperforming. But now it appears it's moving towards that 45,000 odd mark. Well, let's move on and let's get you some market opinion. Amid the markets hitting all-time highs this month and talks of bubble and exuberance in the market, Prashant Nair caught up with market veteran Madhu Kela to get his take on the current market juncture and a whole host of other themes. Let's hear that out.
I would say that the entire market is not in that phase at all. That, if you look at the return of overall Nifty in the last 2 years, is merely 7-8%, right? A lot of large caps have not returned any significant investment return in the last 2 years or so. We are up a lot from the low which we made at COVID time. But there is really the word exuberance in a lot of large companies. And the large companies are actually doing well, but the stock prices are not going down or going up, which means their valuations, in a way, are correcting. Like if you take some of the private sector banks, there's been hardly any return in last 2 years. So I don't think market as a whole can be termed as exuberance or
But are there
euphoria.
pockets where things are...
There are surely pockets, and obviously we would like to talk about that. There are surely pockets where there is clear exuberance, where I think the stock prices are clearly running ahead of fundamentals, right? Maybe 2-3 year fundamentals, and that is where investors need to be really watchful that and do their homework completely. And I can tell you there will be exuberance even in public sector bank. There is some stock, small public sector bank trading at 3 times book value. Now, we were the one of the few people who said that we want to invest in public sector bank. But clearly, I can't reconcile or resonate with a 3 times book value and which has risen so quickly.
Yeah.
So there are pockets of stocks in lot of sectors where there is a clear exuberance, and that is what one has to be watchful. The irony, Prashant, is that there is a compelling buy in the public sector bank at one end, and there is exuberance on the other end.
Within the sector. But let me stop you right there, because I'll get to where the exuberance is, where there is still opportunity in just a bit from now. But let's just start with the good stuff.
Yeah.
We are actually talking about exuberance, etc., because we are in a pretty good place.
Sure,
right?
absolutely.
I mean, things are looking good for India as an economy. And that is the reason why people want to come in, people want to invest. And hence the talk of where the valuations justify this or not.
Exactly.
So lay the context, in that sense, because there's a lot happening in the world.
Sure.
And, this China +1, developed world perhaps slowing down a little bit. Where does India find itself within this context?
Prashant, this is the day for which people like me have lived for. That, someday India will get recognized. Someday the world in general will talk about India much, much more than what we have been spoken and what we deserve, right? All the good policies which are being persuaded by the government in the last maybe 8-10 years, it is all coming together. And this is coming at a time when, the world is struggling. World is struggling for the word growth. World is struggling to manage inflation. World is struggling to put together policies. Now, if you look at, let's say, for instance, just from a comparison perspective, China received $1.5 trillion of FDI in the last 10 years. Just imagine a small shift of that FDI into India. What kind of numbers can we attract over the next 10 years?
Right.
Yes, so the way the world is geopolitically, reorganizing itself, India is a clear beneficiary.
Okay, let me take off from that what you said, right? And you're a big believer in themes, catching the right theme, right?
Yeah.
So global economy, as you said, perhaps is not looking as great, right?
Sure.
I mean, things are slowing down.
Sure.
Locally, things are looking good. But locally also, you would agree there is a clear differentiation. Consumption is hurting, especially the lower consumption.
Lower end consumption is hurting.
What is doing exceptionally well is government capex.
Sure,
right?
Absolutely, yeah.
So
and high-end consumption.
And high-end consumption.
Yes.
So are those, when you talk about themes, should we kind of limit ourselves to finding opportunities in these two areas, high-end consumption and sectors benefiting from government capex?
So let me talk about one very large theme before we come into specific investable themes.
Right.
So I personally feel that this whole carbon neutrality is a very, very large theme. And it's a much bigger problem than what the world is actually talking about or recognizing it. This is a very large theme. Like what you are seeing, whether even in India, when you look at what is Mr. Ambani talking, what is Mr. Adani talking, what is Mr. Jindal talking, they're all talking of investing billions of dollars into this theme, into green energy, into electric vehicles, so this is, Prashant, in my mind, a mega trend.
Which will last for many
years.
Yeah.
The other thing which
bring it down to investables.
Yeah.
I mean, how does one?
So within that, you have to find
what have you done? Give us a with of course full disclosure.
With the full disclosure, I just recently invested in a private company which I can talk very freely about. A company called Wari.
Okay.
Right, which will hopefully come into public issue soon. If people just follow this now, finding ideas in this theme is not a big issue at all. There will be many companies which will come, and there will be, I think, billions and billions of dollars of value creation opportunity is here.
Okay.
The other theme which I would like to take, again, big picture, is on artificial intelligence.
Okay.
How that is going to impact the world, how it is going to reshape.
Sure.
This is an event which is happening after maybe 20 years after the invention of internet. In my understanding, this is the biggest event after internet. Now, it is early days, right? People like you and I are still reconciling how it is going to, and so there will be distortion into a lot of businesses, and it will be a big opportunity for a lot of businesses. So these are two really large themes, from a next 5, 10, 20-year perspective. There are many ideas.
In the listed space, is there a way to play?
There will be enablers. There will be companies which will use, and you will hear a lot more of what I'm saying even from the IT services companies. And you should get some of them in your studio and ask them whether what I'm saying is right.
Well, interesting chat as always by Madhu Kela. We'll keep playing out those snippets all through the day. Well, let's move on to our next corporate, JB Chemicals. Well, that's JB Pharma. That's a stock on our radar. It's up more than 40% in this year. The company's Q1 performance as well was fairly good. To discuss how things are shaping up, Mr. Nikhil Chopra, the CEO and whole-time director of JB Pharma, joins us on the show. Hi, Mr. Chopra. Good morning. Thanks so much for joining in. Well, I want to talk about a lot of aspects and how business is shaping up. But first, on the promoter entity, KKR, well, they have close to around 54% stake in the company. They bought that 54% stake for around 3,100 crores. But you all have done very, very well. And now that stake is valued at close to around 12,000 crores. What's the plan out there?
So, Niger, first of all, good morning and thank you for inviting me on the show. I think we are running a steady ship, and being now in top 25 and the fastest growing company in Indian pharma market, and touch wood, our international business is also doing well. I think at mid-teen that we are able to grow, and we are able to grow. EBITDA growth is around 18 to 20%. I think KKR is here to continue and look at what more we can do with this asset and serve more and more number of patients with quality medicines coming from the house of JB. That is what I can say at this moment of time.
Years they've already tripled their investment, so that's why there would be some kind of inclination, right? Take some money off the table, going by the kind of deals and the kind of appetite that we have seen.
See, I can't comment, Niger, on this. Conceptually, we have a stable management team working at JB, and there are people from across sectors who have joined in the senior management team. And we continue to invest in the business. We continue to look at what more we can do wherever we are present within India or within international markets. That is what we are aiming at. Recently, also we got one of our product approved in US FDA. So that is doxepin. And we have been filing 3 to 4 ANDAs every year in US. We've been filing 8 to 10 products in our ROW market. Last couple of years, we invested close to $200 million in acquisitions, and touch wood, all our acquisitions are fairly doing well. So we are here to stay.
Okay. I wanted to understand a little more about what the revenue potential is, because it was a very strong Q1 that you clocked in, right? You saw a domestic growth of almost 17%. And even in the chronic segment, you had mid-teens growth. So I want to understand what is the volume and pricing tracking at right now as we speak in the domestic market, and what is the exit rate for FY24?
Hello, Sonia. And if you look at MAT, August 2023, JB Chemical continues to grow at around 20%, which is a mix of volume, price, and overall new products introduced. And market is growing at around 10%. Volume growth for us is high single digit, close to around 8-9%, as compared to market volume growth, which is 1 to 2%. And price growth is around 6 to 7%. And new introductions are contributing around 3 to 4% to this growth. We could shy away touching 900 crores for Q1, which we grew at around 17%. And our EBITDA margins were healthy, which were 27% in accord to the guidance that we've been giving, 25 to 27%. We should be ranging plus minus close to 875 to 900 crores every quarter. That is what we are aiming. You should see this probably happening in Q2, Q3. Our chronic contribution overall has improved, and we are now the fastest growing company in cardiology market in the country. In 2020, when with our organic brand Silacar and Nicardia, we were 13th ranked company, and today we are 8th ranked company with the acquisitions that we did with heart failure pill, with rosuvastatin, Razel brand from Glenmark. So we are the 8th ranked company, and our aspiration is to be in top 5 in cardiology market in the country. That is where we stand from overall guidance and overall our presence in chronic therapies in the country.
Nikhil, just to get the numbers right, the domestic revenue growth in the month of August was 20%, right?
No, don't market. I'm talking of MAT 2023 August. Its growth is 20%. For the month of August, we grew at around 7% as compared to market growth of 4%, 4 to 5%.
Okay. But isn't that much slower than what we've seen in Q1? Because in Q1, your domestic revenue growth was 17%. So August has come down to 7%.
So it may be because of the higher base last year, but our chronic chronic growth continues to be in double digit, and acute it is more Rima from a season perspective. And this year it is good for the Indian consumers that they did not suffer from many of the GI infections. So it is good for the population.
All right. Mr. Chopra, your margin band has been 25 to 27%. Now, your cardiac brand, Azmarda, that as well, has helped in the first quarter as well and likely to help from here. Input costs have cooled off. Freight costs as well are lower. Do you think you can hit the upper end of the band? Should we be working with 27% given all the ingredients?
Niger, we could deliver the upper side of the brand for Q1. Now, if you look at the freight cost, overall has come down in a big way as compared to last year. The RMPM costs have peaked, but they have not declined. They are stable. So if we see next 3 to 6 months, if RMPM cost probably comes down, then you can assume in terms of the high peak EBITDA margin, that is what we have, the guidance that we have been giving.
Okay. Can you tell us if there are, in the near future, what would the acquisitions look like? Any target number that you have? How many acquisitions are you planning to do in the next 12 to 18 months? And the recently acquired portfolios as well, any indication of how they've performed?
Yeah. So let me first talk about the recently acquired portfolio. Let me talk about what we acquired from Glenmark. The entire rosuvastatin portfolio, which we bought it. We bought around 55 to 60 crore revenue at around 300 crores with healthy gross margins. The secondary demand, which was there every month, was close to 4.5 crores. And we were 10th ranked brand in the overall rosuvastatin franchisee. In last 6 to 8 months, our secondary demand from 4.5 crores has gone up to 5.5 crores. And now we have climbed from 10th to 8th rank. So there's a good traction, and overall this franchisee for erstwhile company Glenmark was not growing for last 3-4 years. We aim to grow this franchisee at around 12 to 14%. On Sonia, on the acquisition front, from a guidance perspective, we continue to evaluate assets. We continue to look at if there are assets available which are quality, progressive, may not be growing but are in a progressive category of growth. And if we can turn around with our capability, surely we would like to acquire. And equally, we also look at another angle from a perspective of improvement in gross margin. That is what we could do for Asmada. That is where we stand. So either a growth trajectory or a gross margin improvement trajectory. Those are two things. Third is the payback period that we commit when we get any acquisitions, when we get the approval from the board, is around 6 to 7 years. That is what we want to do. That is where we stand. And lastly, maximum what we can leverage is 1.5 times of our EBITDA value, where we stand from the value of acquisition that we intend to do. But nothing that I would like to say that which is immediately on the horizon. But this is what parameters we keep in mind, and there is no pressure on us to do any acquisition. Last couple of years, we have invested close to $200 billion. We may not do anything. We may acquire depending upon what is available, and if we think that we can turn it around.
Just very quickly, Nikhil, do you think you will be cash positive by the end of FY24 because you have been bringing down your debt?
Yes, we'll be cash positive. Yeah.
Okay. All right, we leave it at that. Thanks a lot for joining in, and all the best with the business. That's JB Chemicals. Let's do one thing. Let's move on and talk and introduce a new segment to you, the CNBC-TV18 Stock Capsule, a segment where we focus on a buzzing stock. We talk about the company's fundamentals, key triggers, the pros and cons. Today, the focus is on Tarsons products. In case you don't know what this company is about, Ekta is here to tell us all that you need to know. Ekta.
Well, yes, I'm looking at Tarsons today. Let's start with what exactly the company does. The company manufactures plastic labware. So, for example, it manufactures both consumables as well as reusable products within this space. This includes Petri dishes, tubes, vials, sterile media bottles, etc. It caters to pharmaceuticals, academia, contract research companies, diagnostics, export companies. Now, domestic is around 60% or 67% of their sales. Exports is around 33% of their sales. They have 5 manufacturing units. They have a new manufacturing facility which is going to come on stream from Q2, and the company has indicated that it is probably going to help them expanding geographically. Now, just to put it into perspective, Tarsons, however, has reported FY23 numbers which were quite weak. The numbers were impacted by slower demand and a high base due to COVID-19 products, because that's exactly when the demand for the company had shot up. So revenue was down 6% in FY23. Margins, however, were high but lower on a year-on-year basis, came in at around 45.8% versus 50.8%, and profit at around 81 odd crores. Cash flow from operating activities in FY23 stood at around 100 crores. For Q1, revenue was lower and the profit was at around 9.5 crores versus around 22.8 crores year-on-year. Now, in terms of its stock performance, the stock listed in November of 2021, it's around 19% away from the issue price of around 662. It is in fact close to its 52-week low. The stock in fact has corrected 37% also from its 52-week high of around 848 odd rupees. It is trading at around 35 times the trailing FY23 PE.
All right, thanks a lot for that, Ekta. Well, let's do one thing. Let's also get Mitesh Thakkar on board. We also have 2 listings, by the way, that's happening anytime now in about 3-4 minutes. So we'll get to that in a bit. But Mitesh, very quickly on the market, once again, it's resumed its downside. The Nifty is now down 45 points. So very volatile. How are you approaching it?
It's looking a negative kind of market. I think the Bank Nifty positive news flow was kind of holding the markets. But if the Bank Nifty also, fails to capture 45,000, I think good chance that we are looking at 44,000 first and even 43,450 as the next level. So there is some downside pressure, which is very likely, and rallies would be used to sell into. On the stock side, I have 2 sell calls. One of them is Polycab, which appears to be giving a first reversal after a good rally. So Polycab, I would recommend selling with a stop at about levels of 5,160 and a target of around 5,000. And other one is ABB, disclaimer. We have positions as well as we have recommended it to our clients. So the vested interest, but ABB is a sell with a stop at 43.20 for targets of around 4,100.
All right. Thanks a lot, Mitesh, for that. Let's do one thing. Let us take a quick break on that note. We, of course, keep telling you about the new listings that are going to happen in minutes from now. But on the other side, the big story, Lata will be in an exclusive conversation with the team of JP Morgan on the big India EM bond index inclusion. So more on that coming in. Also, JP Morgan's India Investors Summit 2023 kick starts today. You don't want to miss this one. Stay tuned.
Hello and welcome to a very special edition of Market Masters, where the brains trust of JP Morgan is joining us ahead of their India summit. My guests are Sajid Chinoy, the Chief India Economist, Kaustubh Kulkarni, the Senior India Officer and Vice Chair, Asia Pac, and Sanjay Mukim, the Strategist and Head of Equity Research. I hope I got your designations right. Gentlemen, what a great day to have you in our studio at that. Sajid, this is the unexpected first question, but it's just lit up all markets in India. The JPM bond index. I don't know if you all know the numbers better than the rest of the market. How much money are we really talking in terms of what can come because of passive funds?
That's given the amount of assets that track this index and given India's 10% weight, I think from this index, the direct flow will be somewhere in the range of $20 to $25 billion starting from next June over a 10-month period. And then, of course, there'll be some catalytic flows that amount because of this. But I think the larger issue is not so much about the quantum of money. It's about two other things. One is to just have some more heterogeneity in the investor space in the bond market. The more heterogeneity you have, the better price discovery you will have in both directions.
No, but passivity, I mean, you just have to be there.
That was my second point, that it's really passive flows. And I think bond money and debt money now has become, attracts a lot of indices. And so if India has a 10% weight, what you should expect is not too much volatility around that. In the good times, investors may take 10 to 12. If there are adverse shocks, they may go down to 8. So I think that's the part that we should recognize, that this is passive money that's here for the long term, and therefore is, in a way, India tapping into the global pool of savings to finance its current account deficit.
Oh, absolutely. We've had enough experts speaking to us, and the expectation is that, once JPM index bites the bullet, as it were, the Bloomberg, Barclays, the FTSE Russell will all also include. So the numbers that are doing the rounds is probably 40 to 50 billion, only passive. And then there are, of course, actives who want to, take advantage. So, that question to you, Sanjay, how would you look at equity markets if there is this kind of money? Do you think now leveraged companies would be preferred because, it's going to be cheaper to borrow? Would you think banks become a little more attractive? I know you have not rewritten your strategy report, but what may be the likely changes?
Well, I think, and Sajid will be better to comment on the currency and rates impact.
Yes,
but look, this will be to prima facie be supportive of the INR, so you would not be worried about terrible depreciation for at least the next foreseeable future. Will Indian bond yields go down too much? We'll see, I guess. But the argument logically, Lata, will be that a lower interest rate would be supportive of valuations of companies because your WACC in the DCF goes down and so on. My only nervousness is that we are not pricing off the 7.2 in the Indian equity market anyway, right? The equity market is already way ahead of all these inclusions in terms of using a lower cost of capital in its valuations for longer term growth. I personally don't expect any decoupling of India's equities to the global equity sentiment. And that's a theme that we've been writing about for a while, that India's great in the long term, all this structural growth is real, but in the short term, the market does move in line with global sentiment. And that's why, a month ago, we wrote the note that the market still looks very toppish.
No, I take your point entirely on that, but immediately you would think that banks become more attractive. Mark-to-market gains.
Potentially. But I think the equity market tends to look through these mark-to-market gains. I mean, even when you have losses, you don't go and sell some of these stocks anyway. So yes, there will be support to earnings accounting-wise, but I don't think that will be a fundamental reason. Banks anyway look great to us because earnings growth is strong, and it's probably the only sector in the market where valuations are acceptable. Yeah. So the core argument still is very strong.
Very strong for banks.
Yeah.
I'm just coming to you in a minute, Kaustubh, because we just want to get through with this big change that is on us. Sajid, there will be a big inflow of funds starting from June. And according to bond market experts, even ahead of it, active funds may come in. Right. So, how should we approach the Indian rupee?
Yes.
On the one hand, there is the strength in the US dollar. The dollar index is at 105. And the US 10-year yield at 4.5. I mean, why would an exporter want to sell and come when he can get 4.5 for dollar? So, how should one approach the rupee? Yes. And will the RBI have now a big problem? They will not want a rupee appreciation because we may become uncompetitive. Yes.
That's how we're at the 10th anniversary of the taper tantrum, right? What is the biggest lesson we learned over the last 10 years? Buffers matter. right? We had $280 billion of reserves then, almost $700 billion at the beginning of last year. I think the RBI strategy, in my view, should not change, which is that when you do have large balance of payment surpluses, you buy these buffers, you buy the dollars up, because these reserves are not earned reserves, they're borrowed reserves. There are corresponding liabilities in the economy which could exit the day after. So I think we have to think through the general equilibrium impact over here, that if these flows do come, I'd expect the central bank will buy those dollars, will not allow more than a small amount of appreciation. And there is also a corresponding impact on the bond market that we're not fully internalizing. Because when you do buy those dollars, you are generating rupee liquidity. And sterilizing that, which is what the RBI will want to do if you're worried about inflation risks, will entail the RBI selling bonds. So when you think about the net impact on the bond market, essentially foreigners will be buying bonds, but if the RBI is sterilizing those dollar purchases, that to some extent at least, these will be partially offset by the central bank selling bonds. So this is clearly positive from a medium-term passive global savings perspective, but the impact on prices, whether it's bond yields or the rupee, are a little bit more nuanced given the central bank's reaction function.
Do you expect an OMO sales this fiscal itself or in 2023 itself? Because I thought at this moment, if the dollar flow is big,
yes,
RBI will buy the dollars and they're very happy to tighten liquidity,
yes,
because that is anyway their position. You actually see them selling bonds.
I'm not saying this year. I'm saying that when these flows come over the next year, I think what the RBI has done very well is ensure that liquidity is consistent with their rate policy. If US rates are going to be high for long and Indian rates are going to remain at current levels, you won't want liquidity to run ahead of where yields are. Okay. So next year, if you do have a large BOP surplus because of this, it will be understandable why the central bank will want to sterilize these flows.
Right.
One way of sterilizing it, there are many ways to sterilize, is to sell bonds and soak up that rupee liquidity.
I guess they're more independent in selling bonds rather than selling dollars, because that will depend on global matters. But Kaustubh, you have to tell me, who's your audience in the summit? Are you seeing some last-minute rush of FII debt funds wanting to come in? More generally, who are the funds coming in? I also wanted to know if there are more India-dedicated funds and not just funds coming through GEM.
Okay, so I think the way we look at it, there are almost 400 investors attending your conference. I think it's almost 50% more than what we had in the previous year.
Ooh.
So that's the first sign. I think of those 400 investors, almost 300 on the equity side and about 100 on the debt side. We have about 75 companies, which represent almost about 1.2 trillion of the market cap in India. And I think from those 75 companies, there are a number of corporates and others who are also attending a number of sessions and high quality content we have planned. So we have 250 attendees from the corporate side who are coming in. So it's being done at a very substantially larger scale. We would like to welcome more, but I think ironically, we had to stop registrations because I think we just couldn't accommodate anything more.
So those who came after the
No, even before that, actually, even before that. So
okay.
we just run out of full capacity, given I think the response that we have received both from companies and from investors who really want to be a part of it. And I guess the reason
But you would
for
agree that there is money coming not just through GEM funds,
yes,
but now more India dedicated, you would say?
I think not yet, because generally, if you're a large global pool, there is benefit in size. So if you're managing 10, 20, $30 billion of emerging market funds, it is easier for you and more flexible for the fund manager to allocate accordingly, rather than just doing an India dedicated. Having said that, there are clearly India dedicated funds which are being targeted and marketed globally, but the relative size of those is still sub 10 billion. Okay. And we are getting good representation from both sides of investors.
Okay. Sanjay, now to come, when all this money comes and this kind of interest is shown, do you think that Indian equities, I know you said that you're watchful of valuations, but will we trade at higher valuations than, say, the long-term 20-year average?
We already are there, Lata, unfortunately.
Okay.
And if we weren't...
I thought we are still south of the 2007-2008 valuation.
Possibly. So if you exclude the extraordinary periods of valuations post-GFC and the COVID, then we are close to all-time highs on the Nifty already. So if we weren't, then you'd be a little bit more comfortable. But making an investment case saying that the multiple will go higher is always weaker an argument, right? You always want to buy the earnings growth and the compounding that the economy will generate, rather than to base your thesis on saying, I think other people will buy at higher multiples, right? Okay. So the first part, we are confident. You will get decent earnings growth, and actually we've written research that earnings growth in the next few years will be better than the pre-COVID period and so on. But is the thesis based on higher multiples? I wouldn't go down that path.
Let me come to one of the sub-segments that have done extremely well. Mid-cap PSU banks have done very well. And, you know, we just tend to get carried away with the mid-cap PSU banks. Even the small-cap private sector banks, some of them have done very well. So you began by saying that anyway you are very happy with banks and, you know, at the current juncture, they are on your buy list. Would you go down the queue?
Well, I'll take the opportunity to pat ourselves on the back because a few months ago, we write these tactical notes on what sectors look interesting for short-term trades. We did pick out PSU banks 4 months ago in one of our research pieces. And the thesis for that, Lata, was that we were starting to see, again for the smaller banks, earnings upgrades. And the sector, if you remember, around the first quarter had underperformed the market. So it was a great opportunity to look at sectors or stocks which hadn't done well for a variety of reasons, but were delivering earnings better than expectations and were driving upgrades. I think that's what's kicked in, where it's caught the market by surprise. I mean, we've seen banks do well for the last 2 years, but you had this another mini cycle which has lasted for a while. We do think that the overall loan growth will slow, right? And this is tying into the lack of liquidity in the system. Deposits are a constraint, and margins are coming in under pressure. So the sort of growth that you've got from banks in the last couple of years will slow. But if you look at a combination of growth versus value, the entire financial set is the only thing that makes sense in India, I mean, logically at the moment.
Okay, I'm not done with the sub-segments. There is the other two superb segments, not two, actually three: railways, defense, and power. And many of them are overwhelmingly public sector. So those questions to my experts after a very quick break. Welcome back to this very special edition of Market Masters, where I have been speaking with the brains trust of JP Morgan ahead of their India conference. I've been speaking with Sanjay Mukim, the strategist, head of India Equity Research, Sajid Chinoy, chief India economist, and Kaustubh Kulkarni, the senior country officer India and vice chair of Asia Pacific region. Gentlemen, thank you for your patience. Thank you for waiting by. Sanjay, now to that unfinished argument. Before the break, you spoke about PSU banks. Now, PSU as a theme, defence, railways and power have been doing exceptionally well. More to go?
Operationally, possibly, right? So if you look at the power sector, we've liked it for a while because you've seen a significant improvement in the cash flow dynamics of power companies, where all the reforms have finally started to have effect. Receivables for, let's say, generators have fallen significantly YOY. And you're seeing surprising demand growth, which was actually forgotten in India. For many years, we assumed that demand growth will remain lackluster, and now you're starting to get double-digit demand growth. So the system is tightening quickly. You should therefore see a spurt of capex. So everything's sort of falling in place. The challenge you have is that which company benefits because of this dynamic, because many are regulated return, they don't really have upside to higher prices, or most of it.
And the Discom health is still a question mark, you would think? I mean, are they paying their bills, or will they always pay their bills?
The way I understand it is that this is semi-permanent, if not fully permanent, and it will be very difficult for Discoms to go back to the old ways and stop payments and delay payments and so on. We've seen this happen manywhere. In fact, one of the smaller states I visited recently, met the power secretary, they've reported a profit. The Discom has reported a profit in many, many, many years. Okay. And so if this stays, I think the entire health of the power sector should structurally improve.
So it is in your buy list?
Yes, it is a sector that we have liked from a reform momentum point of view. The others are more capex driven, right? It is driven by momentum of spending, especially from the central government. And there you will have to analyze year on year what is the continued momentum. Do they have the money in the budget to continue the pace at which they have grown in the last 2 years? Our bias is to say that will slow here.
Fair point. Yeah. But the entire mid-cap space, I want to come to you. But before that, let me get the macro clear. Sajid, how is the India growth story shaping up? 7.8 first quarter growth was like, 7.5% below the Q4. Now, Q1 is always lower than Q4, but 7.5% was quite a bit. So clearly some week, the pace of growth is not as superb as it was pre-COVID. But on the other hand, now the recent data from the US, the Fed has actually doubled the pace from 1%, now they expect a 2% GDP. So all told, how is the growth story looking this year and the year now?
Right. So I would look at the drivers of growth, Lata, and what you're seeing encouragingly domestically is there are at least 3 drivers that have combined together in the last year. One, of course, is the central government's unrelenting capex push, which has a big impact on growth in the first 6 months because it's been complemented by state capex, which was weak last year, also joining the party. Secondly has been, and we saw this, that the health of the financial system is now the best in a decade, and you're seeing this in higher credit growth. And the third is the residential real estate cycle, dormant for a decade, is picking up. So all these 3 things have combined and they're contributing to growth. Having said that, a lot of our growth over the last 3 years has come from the export angle. Right? So exports are 24-25% of GDP. Their contribution to growth has been 40% of GDP in some years. The US resilience is very encouraging, but the fact is that that's US exceptionalism because other parts of the world have been far more disappointing, whether it's China or Europe. So we have to brace for the fact that the export tailwinds that we got for much of the last 3 years, first it was goods, then it was services, will begin to fade over the next 12-18 months. And when they do fade, it will be incumbent on the domestic demand drivers to pick up the baton. Now, the public sector is doing its part. So what I'm looking at in the next 12-18 months is what happens to private consumption and private capex. On private consumption, so far it's been the upper end that's been firing. At what point does the lower end, does consumption broaden out to the lower end? And secondly, at what point does public capex translate into more robust and broad-based private capex? 2 risks to monitor, 3 risks to monitor. One is the fiscal impulse in the first 6 months is very strong. You can't get that impulse in the next 6 months. That will have some impact. But 2 more fundamental risks are crude prices. We were in a sweet spot in the first 6 months of the year. Crude is now at $93 a barrel. That will have some impact on margins and earnings and growth. And the second is the monsoon. fingers crossed, good news. September has been stronger, but we have to, El Nino is just getting started. So I would look at the monsoon and crude closely and see what kind of headwinds they create.
Okay. We have now more money in the kitty for, fiscal transfers when the bond money comes. But okay, that's next year. One of the factors that you didn't mention, and I guess that's now taken for granted, Kaustubh, the China plus one story. I mean, we know that Apple has made a big success of it and more could come. There could be more apples to follow. Other apples will follow. So is this a buzz you hear since you are the Vice Chair Asia Pac? Are we seen as a fairly big alternative, and you may be in the thick of many deals?
So I would say specifically from India, it is still relatively early. And we think of China plus one, in fact, our team calls it as globalization 2.0 rather than anything else. But just to give you one stat, between 2019 and 2022, of the US imports from Asia, China contribution has come down by 15 points, and India has picked up 1.5 of that 15, which means the remaining 13.5 has been picked by other parts of Asia, including Southeast Asia, Korea, and others. So the China plus one narrative is actually interesting for two reasons. One, number of existing Indian businesses which were already in the exports area, including, let's say, pharmaceuticals, chemicals, agrochemicals, engineering goods, all of those are seeing substantial growth and traction. So a reasonable amount of investments are actually being done, and they're benefiting because of customers looking to shift away from their existing sources and supply chains in China. But the larger question is whether the existing large capacity which is operating in China and Taiwan also looks for alternatives outside of China and Taiwan. That, as far as India is concerned, is still relatively early.
Okay, they're not dismantling, it's the incremental money that's looking for new homes. And we are high up on the list of possible options.
Yes.
Okay, well, Sanjay, now to come to what's happening in the markets. I mean, the Nifty is 9.5% year-to-date higher. The mid-cap and the small-cap are 27 to 28% higher year-to-date. Right. PSU index 35%, but we discussed PSUs. Now, this mid-cap, I mean, would you still prefer to have more mid-caps in your list than large caps? Your comment on the rally, and what would be your, what would your list look like?
Okay, since I took credit for something we got right, this is something we actually got wrong.
Okay.
Right? Early in the year, we argued that mid-caps already were starting to look very stretched on valuations, and our concern back then, Lata, was liquidity risks. Because in all of these rallies, the one variable that everybody tends to forget every time is liquidity. And mid-cap liquidity is always one way. You can buy the thing up, but try selling it on the way down. It's very, very difficult. Now, what has catalyzed this, and I'm going to give you a very strange answer. If you look at the start of the mid-cap outperformance to large caps, or whether it is the internet companies or consumer discretionary or NBFCs, it's all started on the 13th of March 2023 when the Fed injected money in the system for SVB bailout. Okay. Global growth stocks, growth has a style globally, took a leg up on the day that the money was injected, right? Now, which we did not anticipate. And it has played out exactly as you expect, that anything with the prospect of growth has done well post that injection. What has confounded us is that the Fed has reversed. And balance sheets for central banks are now contracting, but Indian mid-caps have found a life of their own. Yes. Right? So you've seen...
And there is also a lot of money flowing into mid-cap funds, mutual funds, so domestic money.
Probably that flow dynamic which has given further legs to the mid-cap basket. But if you look at MSCI World Growth, it is rolling down. Oh. If you look at the NASDAQ, if you look at AI...
That's a red flag for our mid-caps.
It is. It is. So to your question, would I be now allocating more money to mid-caps? Extremely carefully, if at all.
Okay, okay. But your preference would be large cap. What would be the top?
Right. So we've said very clearly, investor portfolios should move to larger cap value stroke quality plays. We've been saying banks make a lot of sense.
Okay, banks first and then whatever. Consumer discretionaries, construction companies, capex.
So discretionary is the growthy aspect to it. So we prefer staples over discretionary. Now, yes, we have written notes as well saying that the festive season looks stronger than expected. And if that actually plays out, then there are some discretionary baskets that might do well tactically. But from a style point of view, I'd rather not be in the growth basket. Therefore, staples make sense. Yes. Two-wheelers, for a recovery point of view, we like Like I said, power. We like the real estate space where, again, you're starting to see continued momentum despite the mortgage rate increases. So there are genuine bottom-up opportunities still that we like. But as a style, stay away from the hyper growth or the more hope trade stocks in the market.
Okay, I'm being warned, and I may even lose my job, but I have to ask you this last question very quickly. The savings, household savings becoming 5.1, it's a 47-year low, and household indebtedness increasing. Just interpret it, extrapolate it for the macro.
So firstly, it's one small sliver. We have to look at the whole pie. What you're seeing is gross savings has not fallen, but household financial liabilities has gone up, which should not be surprising given where credit growth has gone largely to retail and to households over the last 18 months as banks have become less risk averse. But if you step back and look at the economy-wide perspective, we don't have the detailed data, but you can back out what's happening because the current account deficit is nothing but the investment savings gap. We know the current account deficit. We know the public sector's investment saving gap because we know the fiscal deficit. If you back it, and we know investment for the economy. If you back it all out, the early read is for FY23 gross private savings perhaps are down by 1.2% of GDP. This is not surprising because when you get so much exuberance in the banking system, leverage does pick up. But we have to watch this closely because if you're seeing consumption being financed by running down of household savings, that is something that we'll have to keep a very close eye on.
Okay, yeah, because we need that fund growth. Out of time, but not out of questions, through the summit, we will try and catch you all and other experts from JP Morgan and other guests who come there for more discussions on the Indian economy. Thank you very much, Sajid, Kaustubh and Sanjay, and I hope you have a great conference out there. Well, that's a wrap on this very special segment. Thank you very much for watching.